In aviation, there's a moment during takeoff that every pilot respects. It's called V1. Before V1, if something goes wrong, an engine failure, a fire warning, a critical systems problem, you can still reject the takeoff. Pull the throttles back into full reverse and apply max braking. Stop the aircraft, reassess, but after V1, everything changes. After that speed, the runway remaining is no longer enough to stop safely. The decision has effectively already been made. You are committed to flying the jet. And right now, NVIDIA may have reached that point because behind the headlines, behind the stock price, behind the excitement surrounding artificial intelligence, NVIDIA has made one of the largest industrial commitments in modern technology history, over $119 billion in future supply obligations, not for products already sold, not for guaranteed revenue, but for infrastructure NVIDIA believes the world is going to need. That raises a very important question. What does NVIDIA see that much of the market still doesn't? This is Captain Pierce with SkiesCapital. Think clearly, invest better. Today, we're going under the cowling of the token industry. This is episode 1 of the Token Economy series. Commit point, let's go. For a moment, NVIDIA looked like it had hit turbulence. The company's China strategy was suddenly disrupted when the U.S. government restricted exports of the H20 chip, a version of NVIDIA's processors specifically designed for the Chinese market. Almost overnight, billions of dollars in expected revenue came under pressure. The company recorded roughly $4.5 billion tied to inventory and purchase obligation charges connected to the transition. Margins compressed, China demand became uncertain, and many investors started asking the same question. Had the AI trade moved too far, too fast? But at almost the exact same time, another story was unfolding underneath the surface. Data center revenue was exploding to record levels. Every major hyperscaler, Microsoft, Google, Amazon, and Meta, was racing to secure Blackwell systems faster than NVIDIA could physically deliver them. Cloud providers weren't slowing orders down, they were accelerating them. Then came another major signal. NVIDIA authorized an $80 billion stock buyback program. That's not the behavior of a company preparing for contraction. That's management signaling extraordinary confidence in future cash generation. And this is where the story becomes fascinating. Because NVIDIA simultaneously looked deeply vulnerable and nearly unstoppable. One side of the market saw government risk, margin pressure, and geopolitical uncertainty. The other side saw an industrial scale infrastructure boom that may still be in its earliest stages. And understanding that contradiction may be the key to understanding where the entire AI economy is heading next. For NVIDIA, the first major shock was not competition, it was policy. After earlier export restrictions, NVIDIA designed the H20 chip specifically for China. So let's break this into 3 parts. Number 1, why did the H20 exist? It was a China-compliant AI chip built around US limits, designed to protect a major revenue lane without violating the rules. That matters because China had been an important market for NVIDIA's data center business. Number 2, why did the ban hurt? The US government added a new license requirement for H20 exports. That changed the economics almost overnight. NVIDIA recorded roughly $4.5 billion in charges tied to excess inventory and purchase obligations. And the company said it could not ship about $2.5 billion of H2O revenue in the quarter. That is real money. Number 3, the real lesson. AI chips are no longer just products. They are geopolitical assets. Policy can erase demand overnight, and compute is now strategic power. That's the key point for investors. NVIDIA may control the cockpit, but it does not fully control the airspace. After the government shock, NVIDIA needed a recovery engine. That recovery engine was Blackwell. Blackwell is NVIDIA's next-generation AI GPU architecture, built for training, inference, and token generation. And this is where the story changes, because Blackwell was not just faster, it changed the economics of AI. Number 1, token output efficiency. Before we go further, let's define one word simply. A token is one of the basic output units of AI. It can be part of a word, a full word, punctuation, code, or part of an answer. As a rough rule of thumb, one token is about 3/4 of a word, or about 4 characters. So when we talk about tokens, we are really talking about the measurable output of artificial intelligence. And that is why Blackwell matters. More tokens per second means more AI work can be produced from the same infrastructure. Number 2, cost per token falls. This may be the most important point on the slide. In NVIDIA's benchmark example, the cost per million tokens dropped from about $4.20 to about 12 cents. That is not just an engineering improvement. That is an economic unlock. When the cost of producing AI output falls, new business use cases become possible. Number 3, inference becomes the market. Training was phase 1. That was the headline phase, building the big models. But inference is phase 2. Inference is when those models actually get used. Every customer service assistant, coding tool, research assistant, logistics planner, and enterprise AI agent creates ongoing token demand. That makes inference a recurring demand wave, and Blackwell was built for that wave. Number 4, hyperscaler capacity scramble. Microsoft, Google, Amazon, Meta, and the rest of the AI infrastructure world are not just buying chips for experiments anymore. They are trying to build industrial scale AI capacity. That is why demand feels so urgent, because if tokens become the output unit of the AI economy, then the companies with the most efficient token factories may control the next layer of corporate infrastructure. That is why Blackwell matters. It did not just help NVIDIA recover from the H20 shock, it gave NVIDIA a new flight path. Now we get to the real commit point. The number is $119 billion, but we need to be precise. This is not traditional capital expenditure. NVIDIA is not simply saying we spent $119 billion building our own factories. What NVIDIA disclosed is manufacturing, supply, and capacity commitments. In plain English, NVIDIA is reserving the AI hardware supply chain. That includes the pieces needed to keep Blackwell systems moving. Advanced chip fabrication at TSMC, high bandwidth memory, advanced packaging, server and rack integration, and the data center infrastructure needed to actually deploy these systems. This is why the aviation analogy matters. NVIDIA is not buying fuel for this quarter. They are reserving the fuel pipeline years in advance. And that tells us something important. Management is not acting like AI demand is temporary. They are acting like AI infrastructure demand is going to remain large enough, long enough, and urgent enough to justify locking up supply before the rest of the market can get it. That is the bullish side. If NVIDIA is right, this is strategic genius. They secure scarce capacity, protect their lead, and stay at the center of the AI build-out. But there is another side. If demand slows, if customers delay orders, if competitors gain share, or if the AI spending cycle cools, these commitments can become a problem. NVIDIA itself warns that long manufacturing lead times and uncertain supply can create mismatches between supply and demand. The company also says that if it overestimates demand, it may not be able to reduce supply commitments quickly enough. That is why this is the commit point. Before this scale of commitment, NVIDIA had more room to maneuver. After this scale of commitment, the company is much more exposed to the accuracy of its own demand forecast. And that raises the question at the center of this episode. What does NVIDIA see coming that makes a $119 billion commitment look rational? Now we need to balance the flight plan, because the $119 billion commitment is bold. But if demand disappoints, bold can become reckless. So what could break the thesis? Number 1, oversupply risk. NVIDIA is locking in supply ahead of demand. That works beautifully if customers keep buying. But if AI demand slows, or if orders get delayed, NVIDIA could end up with too much supply relative to actual demand. Number 2, AI CapEx pullback. The major cloud providers are spending aggressively on AI infrastructure. But if Microsoft, Google, Amazon, Meta, or other large buyers slow or shift their spending, the ripple effect could be significant. Number 3, margin compression. Right now, NVIDIA has extraordinary pricing power. But if costs rise, customers push back, or competitors offer good enough alternatives at lower prices, margins could come under pressure. Number 4, geopolitical escalation. The H20 situation already showed us that policy can change the flight path overnight. Export restrictions, China retaliation, Taiwan risk, or new supply chain pressure could all change the equation quickly. Number 5, competitive disruption. NVIDIA's moat is real, but it is not permanent. AMD is investing heavily. Google has TPUs, Amazon has Trainium, Broadcom is helping build custom AI silicon, and the largest customers have every incentive to reduce dependence on one supplier over time. Number 6, AI ROI delay, this may be the most important long-term risk. If corporations spend heavily on AI but do not see measurable business returns, demand for inference infrastructure could slow. That does not mean AI fails. It means adoption may take longer than the market expects. So this is the balanced view. If NVIDIA is right, the company is securing the scarce infrastructure behind the next computing era. But if demand disappoints, those same commitments can become heavy. That is why this risk checklist matters. The thesis is powerful, but the risks are real. Now we have to ask the obvious question. Why would NVIDIA management be willing to risk it? Why lock in $119 billion in manufacturing, supply, and capacity commitments? The answer is demand signals. Management is seeing signals that may be larger than what Wall Street fully appreciates. Number one, the hyperscaler CapEx wave. The largest cloud providers are not just experimenting with AI anymore. They are building AI capacity at industrial scale. Microsoft, Google, Amazon, Meta, and other major platforms are spending hundreds of billions of dollars on data centers, chips, networking, power, and cooling. That matters because NVIDIA's demand is not coming from small speculative buyers. It is coming from the companies building the backbone of the AI economy. Number two, the sovereign AI race. This is no longer just corporate demand. Countries want domestic AI capacity. They want their own infrastructure, their own models, their own compute, and their own control over strategic AI systems. That means compute is becoming part of economic policy, national security, and industrial strategy. Number three, enterprise AI phase two. The first wave was hyperscalers training foundation models. The next wave is enterprise deployment. This is where corporations move AI from pilots into production workflows. Customer service, coding, legal research, logistics, finance, medical workflows, and internal productivity tools. That matters because enterprise deployment creates recurring demand, not just one training run, ongoing usage, ongoing inference, ongoing tokens. Number four, token demand surge. Goldman Sachs research expects token consumption to increase 24 times by 2030. That sounds abstract. So here is the simple version. If AI agents become common inside companies, they will not just answer one question and stop. They will read, reason, check, revise, summarize, search, code, schedule, and act. Every step consumes tokens, and every token requires compute. Number five, the CUDA software moat. NVIDIA's advantage is not just the chip, it is the ecosystem around the chip. CUDA, developer tools, libraries, networking, and optimized software make NVIDIA harder to replace. Competitors can build powerful hardware, but customers also care about what is already trained, tested, optimized, and deployed. That creates switching costs. So this is why management may be willing to take the risk. They are not looking at one quarter. They are looking at a demand curve powered by hyperscalers, governments, enterprises, token growth, and software lock-in all at the same time. That does not eliminate the risk, but it does explain why NVIDIA may believe the commit point is rational. Now let's step back from NVIDIA for a moment and look at the historical pattern, because this may not just be a chip cycle, it may be an infrastructure cycle. And throughout history, major infrastructure cycles tend to follow a similar pattern. Infrastructure often comes first. Demand becomes visible later. The winners become platforms, the losers become cautionary tales. Start with railroads. In the late 1800s, railroad infrastructure was built ahead of fully proven demand. Not every railroad company survived. A lot of capital was destroyed, but the rail network itself became one of the backbones of the American economy. Then came electricity. The grid had to be built before every appliance, factory system, and household use case was obvious. Infrastructure came first. Applications followed. Then came the internet. Fiber networks were overbuilt during the dot-com era. Many companies failed, but the infrastructure did not disappear. That fiber helped power the digital economy that came later. And now we may be seeing a similar pattern with AI infrastructure. Data centers, GPUs, high bandwidth memory, advanced packaging, networking, power, and cooling are being built before the full demand curve is completely visible. That is the parallel. Not that NVIDIA is guaranteed to win, not that every dollar of AI infrastructure spending will earn a good return, but that infrastructure at major inflection points often gets built before the market fully understands how big the end demand may become. That is why NVIDIA's $119 billion commitment matters. It is not just a supply chain number. It is NVIDIA saying, we believe the AI economy will need this capacity before the market fully understands the size of the demand curve. So the key question is simple. Is NVIDIA overbuilding into hype, or is it laying the digital railroad for the token economy? Now we're at final approach. Here is the captain's call. The market sees NVIDIA selling chips, but management is acting like it is building the power grid for a new industrial era. That is the thesis. First, this is infrastructure, not just hardware. The $119 billion commitment tells us NVIDIA is not preparing for a normal product cycle. It is preparing for data center scale production, longer ordering horizons, and an AI infrastructure build-out that management believes will last well beyond the next quarter. Second, demand is real and visible. Hyperscalers are still building. Governments want sovereign AI capacity. Enterprises are moving from pilots into production workflows, and token demand may become one of the core measurements of the AI economy. That gives NVIDIA multiple demand lanes, not just one, but third, the risk is real too. Geopolitics can change the flight path overnight. A small group of hyperscaler customers still drives a large portion of demand. Competitors are coming, and if companies do not see real returns from AI spending, the pace of infrastructure demand could slow. So my thesis is this: NVIDIA's position is powerful, the demand signals are real, and the $119 billion commitment may be rational if the token economy develops the way management appears to expect. But this is not a risk-free flight. The commit point has been reached. Now the question is whether the demand curve shows up fast enough to justify the fuel NVIDIA has already reserved. That is why I would call the thesis improving but high consequence. Turbulence is not a flight plan change, but from here forward, every instrument matters. This has been episode 1 of this 3-part token economy series. If you found this helpful, please like and subscribe. It genuinely helps the channel reach more long-term investors who are trying to think clearly about the companies they own. In episode 2, we'll move from NVIDIA's supply chain commitment to the hyperscaler arms race and why Microsoft, Google, Amazon, and Meta are all fighting for AI capacity. This is Captain Pierce with SkiesCapital. Think clearly, invest better. For educational purposes only, not investment advice. Keep the blue side up. Safe skies. I'll see you in episode 2.